Becoming a better investor isn't about making the most money possible or generating 1,000x returns. While it would be nice, being a better investor is about understanding your purpose for investing and then aligning your investment decisions with what you want your investments to accomplish. For example, if you work a 9-to-5 and your goal is to retire at 40 and have $2 million invested to live off of, you're going to approach your investments a lot different than someone who's trying to start a business and is going to be investing in themselves and what they're trying to build, because that investment is going to turn into one of their biggest assets. Like, they're still going to need to invest elsewhere, but it's just going to be a different approach. So we know there's no one-size-fits-all approach to investing, but how do you actually become a better investor? One of the first things is to always do your own research. Like, there's a lot of good information out there, there's great research from professional investors, but there's also a lot of just misinformed, bad financial advice out there that probably isn't in your best interest to listen to from an investment standpoint. And that's not to say that you can't consume it and use it to help form your own opinion, but if you hear anyone ever talking about investments, you should always do your own research and fact check and understand if that investment is appropriate for your situation before putting money into it. Second, one of the easiest ways to become a better investor is to reframe your mindset. Instead of viewing investing in the stock market as a casino where you may or may not lose money, if you view it as a lifelong activity, it not only becomes easier to manage your emotions when you see the prices go up and down, because you know you have several decades before you're gonna need the money, your odds of making money increase the longer you stay invested. This is a quick graphic I made with data from Morningstar and BlackRock that shows how the odds of making money change the longer you stay invested. While past performance does not guarantee future results, as you can see, the longer you stay invested, the higher your odds are of making money. Next, before you start investing, I'm a believer that you should have a little bit of a cash reserve set aside, like maybe 1 to 3 months of living expenses. The reason you want to do this is because if you invest money without having any savings, if an emergency comes up or if you need cash for anything, you're most likely going to have to, one, either take on credit card debt, which isn't good, or you're going to have to sell off some of your investments, and that could leave you with an unexpected tax bill, and it also stops your investments from growing. And one of the best ways to become a better investor is just to stay consistent with it. You're not going to experience significant returns overnight, and successful investors spend years investing in the market, being consistent with it, and a lot of successful investors automate their contributions so they don't even have to think about it. You could set up an automation for $50, $100, $1,000 each month. Just send it straight over to an investment account, and maybe you set the automation for a couple days after your second payday, so paycheck has time to land, bigger expenses at the beginning of the month are covered, and you can start setting aside some money each month. Reducing risk is a very important part of becoming a better investor, because if you don't take the time to properly evaluate your own personal risk tolerance and then the risk that you're taking with your investments, you could end up in a bad spot and potentially lose money. One way to do this is by diversifying your investment. So this would be like investing in the whole S&P 500, the stock market index, instead of being 100% in GameStop. Another way that I kind of touched on is by knowing your risk tolerance. So someone who's 25 years old with several decades until retirement is going to approach investments a lot differently than someone who's maybe 55 and they're about to enter retirement in a few years. But either way, you want to limit your risk to a certain level that still allows you to capture some of the upside returns. One of the last things is minimizing fees. And there are a lot of low-cost investments out there that are great, but there are also a lot with high fees. And unfortunately, those are the ones that tend to get pushed by financial sales reps because they make the most commissions off of those. Those high fees are going to eat into your returns, so you always need to check like the expense ratios and all the fees associated with an investment before doing so, because you may end up with something that's way too high in fees and it ultimately takes away from your actual investment returns. And the last way I have to become a better investor is to reduce your taxes. There are a lot of different strategies that can be used, and a lot of them vary depending on your own personal situation, so that you know kind of what's available and what isn't. But it's important to be aware of the tax impacts when you're investing, so like short-term and long-term capital gains, because if you sell an investment without kind of knowing what the impact is going to be, you could get hit with an unexpected tax bill that you're going to have to sell off other investments for. And when you're running numbers and running projections, you want to focus also on your after-tax return, because depending on the type of account you're invested in, that difference could be huge between pre-tax and post-tax. But that's all I got. To recap, a few ways to become a better investor include doing your own research, being patient and thinking long-term, having a cash reserve, staying consistent, reducing your risk, minimizing fees, and reducing taxes.